Welcome to the deep dive. We are absolutely thrilled to have you with us today.
Truly, it's great to be here.
If you are listening to this right now, you are probably, I don't know, staring down the barrel of a massive professional exam.
Right, maybe your CA finals.
Yeah, or perhaps you're prepping to step into a really high-stakes audit committee meeting, and you just need to get your head wrapped around some seriously dense regulatory material.
It can be a lot.
It really can. So I want you to just take a deep breath. Relax. Because today we are basically acting as your specialized academic tutors.
That's our mission today.
Exactly. Our mission for this deep dive is singular and incredibly focused. We are going to help you master a highly technical, absolutely crucial topic.
The audit of non-banking financial companies, or NBFCs.
Yes, NBFCs. And we're going to do it in a way that actually makes these complex rules stick in your brain permanently.
That is the goal. Because when you're confronted with pages and pages of Reserve Bank of India circulars.
Oh, the circular.
Right, the percentages, the compliance checklist, the provisioning matrices, it can easily just look like an impenetrable wall of text.
Yeah, it's completely overwhelming.
It is. So for this session, we're drawing directly from the authoritative regulatory guidelines on the special features of auditing these institutions. We'll be dissecting the RBI's regulations, the relatively new scale-based layers, capital adequacy requirements, and the rigorous checklist every auditor is legally bound to follow.
And what's your specific angle on this today?
My role here is to walk you through the logic. I mean, I'm not just going to list off the rules. I'm going to explain the systemic risks and the potential for financial disaster that these rules are specifically designed to prevent.
Because there's a reason for all the madness.
Exactly. Once you see the danger the RBI is trying to avoid, the regulations actually form a very clear, logical picture.
And I'm here to make sure you never forget that picture. When I was digging through this material myself, my eyes just completely glazed over at the math and the endless lists of criteria.
It happens to the best of us.
Yeah. So to keep it straight in my own head, I actually built a series of cheat codes.
I like the sound of that.
Yeah. Custom memory techniques and mnemonics. I'm going to be sharing these with you throughout the conversation. Whenever we hit a dense wall of criteria, I'll hand you a simple, catchy tool to unlock it in your memory.
That's perfect.
So grab a notepad if you want, or just let us do the heavy lifting while you listen. Let's start with the most fundamental question. What on earth is an NBFC?
Right, the baseline definition.
Yeah, from the Reserve Bank of India Act, specifically Section 45 IF, it defines it as a financial institution that is a company, or a non-banking institution that is a company, which has as its principal business the receiving of deposits or lending in any manner.
Which is a very dry way to put it.
Incredibly dry. Honestly, reading that legal definition doesn't really capture what they actually do out in the real world.
It definitely doesn't do justice to their role in the economy. I mean, to truly understand NBFCs and why the RBI watches them so closely, you have to understand the massive gap they fill.
Right.
They are the absolute backbone of inclusive growth in a large, diverse economy. Think about a traditional scheduled commercial bank.
Okay, picturing a big high street bank.
Right. Banks have incredibly rigid requirements for lending. They demand heavy collateral, massive trails of documentation, flawless credit histories.
Yeah, if you don't fit into their perfect little box, you aren't getting a loan.
Precisely. But what about the vast segments of society that operate outside those neat boxes? What about, say, an entrepreneur in a remote rural area?
Or a growing urban micro-enterprise that deals mostly in cash.
Exactly. This is where NBFCs step in. They cater to a massive, varied customer base. They are the primary engine for the microfinance industry.
So they fund the MSME sector, the micro, small, and medium enterprises?
Yes. And they finance commercial vehicles. Think about the millions of trucks moving goods across the highways. They're huge players in housing finance, too. Essentially, they take on the risk profiles that traditional banks actively shy away from.
So they are out there doing the heavy, risky lifting in the real economy. But here's the tricky part for an auditor, and it's the very first hurdle you will face when you walk into a client's office.
Determining if they actually are an NBFC.
Exactly, because a company might do some lending. Let's say you're auditing a massive steel manufacturing company.
Okay.
They have a ton of excess cash on hand, so they decide to loan some money to a subsidiary. Or maybe they buy a massive portfolio of government bonds just to earn some yield. Does that suddenly make them an officially regulated NBFC?
Not necessarily, and this is a critical distinction.
Right. The RBI has a very specific principal business test to determine if a company has crossed the line into NBFC territory. And this is where I want to introduce our very first mnemonic for you.
Let's hear the cheat code.
When I was trying to memorize this threshold, I came up with a simple tag. Whenever you need to determine if a company is an NBFC, I want you to think of artificial intelligence, but tweak it to AI 50.
AI 50, I like that. It frames the dual nature of the test perfectly.
Let me break down how I use it. The AI 50 test is the foundational bedrock of the auditor's initial assessment. The RBI draws a very hard mathematical line in the sand based on the company's last audited balance sheet.
And it has two parts.
Yes. The A in AI 50 stands for assets. The company's financial assets must constitute more than 50% of its total assets. But, and this is a trap for young players, you must net off any intangible assets from the total assets before you run that percentage.
Very important detail.
Yep. Then the I stands for income. The income generated from those financial assets must constitute more than 50% of the company's gross income.
So it's a dual test.
It is a dual test. You need both the assets and the income to clear that 50% hurdle.
You know, the mechanics of how an auditor actually executes this AI 50 test are worth diving into because it's heavily scrutinized.
Oh, absolutely. Walk us through it.
Imagine you're the statutory auditor. You walk in on day one. You don't just ask management, hey, are you an NBFC?
Right. They might just say no.
Exactly. You pull the balance sheet and the profit and loss statement. First, you look at the asset side. You see their total assets. But like you said, you have to strip out the intangibles. The goodwill, the patents, the capitalized software licenses. You pull those out entirely.
Because those aren't easily liquidated.
Exactly. Then you look at the remaining total. If more than half of that remaining total consists of financial assets, meaning loans they've given out, investments in shares, bonds, debentures, that is strike one.
Okay, got it.
Then you flip over to the P&L statement. You look at their gross income. If more than half of that gross income is generated specifically from those financial assets, like interest income from the loans or dividend income from the shares, that is strike two.
And if both are over 50%, boom, they're an NBFC. They need a certificate of registration or COR from the Reserve Bank of India.
And the auditor's duty here cannot be overstated. Ascertaining the principal business activity is paramount. Every single regulatory compliance requirement, every provisioning norm, every capital adequacy metric hinges entirely on this AI 50 test.
So if you mess this up, the whole audit is fundamentally flawed.
Totally. If the CEO sits across from you and says, look, we're just a trading company that happens to do a little financing on the side, but their balance sheet and P&L scream AI 50, you have a massive problem.
Because the company is operating a financial institution illegally without an RBI registration.
Precisely.
Okay, but wait. Because anyone who studies finance knows there is always an exception. Nothing is ever that clean.
It rarely is.
Right. There are entities out there that absolutely meet the AI 50 test. They're clearly doing financial business, but they get a free pass. They don't need to go running to the RBI for a certificate of registration.
Yes, the exempted categories.
To remember who gets this free pass, I have another mnemonic for you. When you think of entities that are exempt from RBI registration, I want you to think it's a SINCH.
A cinch. Like, it's easy.
Exactly, but spelled SINCH. It's an absolute SINCH to remember the exceptions. Let's unpack SINCH.
Let's do it.
The S stands for SEBI. This includes venture capital funds, merchant banking companies, and stockbroking companies that are already registered with the Securities and Exchange Board of India.
Makes sense.
The I stands for insurance. Any insurance company holding a valid registration from IRDA, the Insurance Regulatory and Development Authority.
Right.
The N stands for needy companies. These are mutual benefit societies notified under Section 406 of the Companies Act.
Okay, getting a bit niche there, but yes.
The C stands for chit funds.
Oh.
Defined and regulated under the Chit Funds Act of 1982.
Got it.
And the H stands for housing finance companies. These are regulated by the National Housing Bank, or NHB. So SINCH, SEBI, insurance, needy, chit funds, housing.
That's a really clean way to remember it.
But I have to ask, if these companies are clearly taking deposits and lending money, why does the RBI just wash its hands of them? I mean, if an insurance company starts acting like a shadow bank, isn't there a huge systemic risk there? Why the free pass?
It's a great question. It's not so much a free pass as it is a delegation of authority to avoid dual regulation. The regulatory landscape in India is incredibly complex, and the RBI is a pragmatic institution.
So they don't want to duplicate effort.
Exactly. They recognize that it's a massive waste of resources and a crushing bureaucratic burden on the companies themselves to regulate an entity that is already heavily scrutinized by another dedicated industry watchdog.
Right, like SEBI.
Take SEBI, for example. SEBI watches stockbrokers and venture capital funds with an eagle eye. They have their own strict capitalization and reporting norms. IRDA micromanages the insurance companies, ensuring their solvency margins are intact so they can actually pay out claims.
And the National Housing Bank handles the real estate risk.
Yes. The RBI is essentially establishing a regulatory turf agreement. They're saying, you are already supervised by an expert authority in your specific domain. We don't need to pile our general NBFC regulations on top of your existing compliance burden.
It streamlines the financial system.
Exactly. If an insurance company starts acting recklessly, it's IRDA's job to catch it, not the RBI's.
Okay, that makes sense. It's like having two different traffic cops trying to direct the exact same intersection. It would just cause chaos and conflicting signals.
A perfect analogy.
Oh, and there is one more very specific exception we need to tag onto our SINCH mnemonic. Core investment companies, or CICs.
Right, the CIC exemption.
If a CIC has an asset size of less than 100 crore rupees, or even if they're 100 crore and above, but they are not accessing public funds, they are also exempt from RBI registration.
That CIC exception is vital to understand, specifically the caveat about public funds. The RBI's overriding mandate is protecting the general public.
Because a core investment company is typically just a holding company, right?
Yes. It usually just holds shares in its own group companies for the sake of corporate structuring. If a CIC is just playing with its own internal corporate money, or money strictly from within its own promoter group, and not taking a single rupee from retail depositors or public markets, the systemic risk to the everyday citizen is drastically lower.
So the RBI focuses its regulatory firepower where the public is actually exposed.
Exactly.
So we've defined what an NBFC is using the AI50 test, and we know who is exempt using SINCH. Now we need to draw a hard line between NBFCs and traditional high street banks.
This is where a lot of people get confused.
Because, honestly, from a consumer's perspective, they look incredibly similar. They both lend you money to buy a car. They both offer fixed deposits with attractive interest rates. Aren't they basically playing the exact same game?
They're playing in the same stadium, but the rules of the game are fundamentally different. And confusing the two is a fatal error for an auditor.
Okay, let's unpack this. To remember exactly where that boundary is drawn, here is your next memory tool. Think of the 4 specific things NBFCs absolutely cannot or do not do compared to banks. The mnemonic I use is DDDP.
4 letters, DDDP.
Let's walk through it. The first D is for demand deposits. NBFCs cannot accept demand deposits. Now, they can accept term deposits where your money is locked away for a specific agreed-upon time, but they cannot take money that is payable on demand whenever the customer walks in and asks for it.
Right, no current accounts or savings accounts that you can just pull from on a whim.
Exactly. The second D is for drawings on settlement. NBFCs do not form part of the payment and settlement system. What does that mean in plain English? It means you cannot write a check drawn on an NBFC.
Which is a huge structural difference.
Yeah. If you have an account with them, you can't hand a check to your landlord to pay your rent. They aren't banks. The third D is the massive one, no DICGC. The Deposit Insurance and Credit Guarantee Corporation facility is not available to depositors of NBFCs.
This is the most crucial point for an auditor to internalize.
And the final P is for priority sector. NBFCs generally do not have the strict minimum exposure mandates to priority sector lending that traditional banks face, where banks are forced by the government to lend certain percentages of their book to agriculture or microenterprises.
Right.
So, DDDP, no demand deposits, no drawings by check, no DICGC insurance, no priority sector mandates. I really want to pause on that third D-way, the lack of DICGC insurance. Can you paint a picture of what that actually means in a worst-case scenario?
It changes the entire risk dynamic. When you put your savings into a traditional scheduled commercial bank in India, a portion of that deposit, currently up to 5 lakh rupees, is insured by the government through the DICGC.
So you have a safety net.
Exactly. Imagine a scenario where a rumor starts that a local bank is going under. People might rush to the branch, but there is a baseline level of calm because the vast majority of retail depositors know the government guarantees their first 5 lakhs.
It stops everyone from trampling each other.
Right, that insurance prevents mass panic. It prevents bank runs from spiraling out of control and crashing the broader economy. Now imagine that same rumor hits a deposit-taking NBFC.
Oh man, total panic.
Absolute unmitigated panic. Because NBFC depositors do not have that safety net. Zero. If an NBFC goes belly up, the depositors could lose every single rupee they put in. They become unsecured creditors in a messy, years-long liquidation process.
That is terrifying for a retail investor.
It is. Therefore, the risk profile of an NBFC is inherently structurally higher for the retail investor. And this elevates the auditor's role to a critical level of public importance.
Because you're the last line of defense.
Yes. You aren't just an accountant verifying math so the shareholders get an accurate dividend. You are the primary frontline safeguard, verifying the financial solvency of an institution holding uninsured public money.
The stakes are incredibly high.
The RBI relies heavily on the statutory auditor's rigorous checks on capital adequacy, provisioning, and asset quality to ensure these entities don't collapse and wipe out generational wealth. The sheer lack of DICGC insurance is exactly why the RBI regulates NBFCs so tightly, and why the audit procedures we are about to discuss are so unforgiving.
It transforms the audit from a compliance exercise into a public defense mechanism.
Yeah.
That perfectly sets the stage for how the RBI actually manages this massive, varied sector.
That's a huge sector to manage.
It is. Which brings us to the biggest regulatory shift in recent history. Effective from October 2022, the RBI looked at the landscape, realized the old classifications were just clunky, and completely rewrote the rulebook.
The SBR framework.
Right. They introduced SBR scale-based regulation. They essentially built a 4-tier pyramid, or like a layer cake, sorting NBFCs based on their perceived riskiness, size, and systemic importance.
A layer cake is a good way to look at it.
To help you visualize and remember these 4 layers from the bottom up, use the mnemonic BMUT. It sounds a bit like mud, but it stands for base, middle, upper, and top, BMUT.
Okay, base, middle, upper, top.
Let's build this cake layer by layer. The foundation is the base layer, or NBFC-BL. Who's this down here?
The base layer primarily houses non-deposit taking NBFCs with an asset size below 1,000 crore rupees. But it's crucial to understand it isn't just a size metric.
It's about the business model too, right?
Exactly, the fundamental nature of the business model. The base layer is the permanent home for entities that the RBI deems to have a minimal systemic footprint. For example, NBFC, P2P, or peer-to-peer lending platforms.
Okay, think of a digital platform. Let's call it FinApp.
FinApp, good example. FinApp simply connects individual lenders who have spare cash with individual borrowers who need a small loan. FinApp itself isn't lending the money from its own balance sheet. It is just a technological bridge taking a fee.
So they aren't holding the credit risk.
Right. Also permanently in the base layer are account aggregators, NBFCA non-operative financial holding companies, and any NBFCs that do not access public funds and have absolutely zero customer interface.
So they are heavily regulated, but the RBI isn't breathing down their necks quite as hard as the big guys?
Exactly. The RBI is employing a philosophy of proportionality. If you are a small, non-deposit-taking entity under 1,000 crore or a pure technology platform that doesn't actually hold credit risk on its own books, your sudden failure wouldn't trigger a macroeconomic contagion.
You might hurt some investors, but you won't crash the banking system.
Exactly. Therefore, the base layer allows for technological innovation and market growth without crushing these smaller entities under the weight of excessive bank-like regulation. But the moment you cross certain thresholds or take on specific riskier activities, you graduate.
And that graduation takes us to the MNBMUT, the middle layer, or NBFC ML. This is where the regulatory temperature really turns up. Who gets bumped into the middle layer?
Well, first and foremost, all deposit-taking NBFCs, regardless of their asset size.
Wow, regardless of size. So even if you're a tiny NBFC operating in just one district, the moment you accept a single rupee of public deposits, you skip the base layer entirely and land in the middle.
You skip straight to the middle. Second, any non-deposit-taking NBFC whose asset size crosses that massive 1,000 crore threshold.
Okay, because they're just too big to ignore.
Exactly. And third, specific types of complex businesses live here permanently, regardless of size. Standalone primary dealers, infrastructure debt funds, core investment companies, housing finance companies, and infrastructure finance companies.
Let's focus on why the RBI immediately forces all deposit-taking entities into the middle layer. I assume it circles right back to our discussion about the lack of DICGC insurance.
100%. The very second an entity accepts an uninsured deposit from a retail customer, the RBI's risk radar goes to maximum alert. They immediately demand higher capital adequacy, stricter provisioning norms, and enhanced corporate governance structures, which are the defining hallmarks of the middle layer.
Because public money is on the line.
Yes. Furthermore, by pulling entities like housing finance companies and infrastructure finance companies into this layer permanently, the RBI is acknowledging the staggering amounts of capital these entities deploy.
Right. They're deeply interconnected with the broader economy.
Exactly. If a major housing finance company collapses, it takes down real estate developers, construction companies, and retail homeowners with it. They
That's
require middle-layer scrutiny.
Moving up the BMUT mnemonic, we reach the upper layer, or NBFC-UL. And this is where the regulation shifts from pure math to actual RBI judgment. It's not just a strict number cutoff to get into the upper layer, is it?
No, it is a highly sophisticated process. The upper layer introduces algorithmic scoring and qualitative judgment by the regulator. The upper layer comprises NBFCs that are specifically identified by the Reserve Bank as warranting enhanced regulatory requirements.
How do they choose them? Do they just point and say you?
Not quite. The RBI uses a specific set of parameters and a scoring methodology based on 4 things: size, interconnectedness, complexity, and supervisory inputs.
Supervisory inputs, meaning what the RBI inspectors are actually seeing on the ground.
Exactly. However, there is one absolute, unavoidable quantitative rule.
Oh.
The top 10 eligible NBFCs in the country, ranked purely by their asset size, will always reside in the upper layer, regardless of any other scoring factor.
Wow. So if you are one of the 10 biggest financial beasts in the jungle, you are automatically in the upper layer.
Automatically.
Yeah.
And the regulatory oversight here is intense. It almost entirely mirrors the oversight of a full-fledged, scheduled commercial bank.
Because they're basically functioning like banks at that size.
Yes, and because the failure of an upper layer NBFC, one of the top 10, would send immediate, devastating shockwaves through the entire Indian financial system.
Which brings us to the final letter in our BMUT mnemonic, the T, which stands for the top layer, or NBSCTL. And this is honestly the most fascinating part of the entire SBR framework, because the top layer is completely empty.
It is entirely empty.
It's a penthouse with no tenants. Why build a regulatory layer if no one is in it?
It is empty by design. The regulations explicitly state that the top layer will ideally remain unpopulated. It functions essentially as a regulatory quarantine zone.
A quarantine zone? That sounds ominous.
It is. It only gets populated if the Reserve Bank observes a substantial, alarming increase in the potential systemic risk radiating from a specific NBFC that is currently sitting in the upper layer.
Okay, let's say an upper layer entity becomes dangerously large, highly interconnected, or starts taking on reckless amounts of leverage in a volatile sector.
Right. The RBI won't just send them a warning letter. They will forcefully yank them into the top layer and apply punitive, hyper-restrictive regulations.
So the goal isn't to manage them up there.
No, the goal of the top layer isn't to manage them. The goal is to force them to deleverage, de-risk, and shrink back down until they are safe enough to return to the upper layer. It is the RBI's emergency brake.
That is fascinating. So if you are an auditor or a student navigating this, you need to understand how this BMUT layer kick completely changes the terminology you use.
It really does.
If you are reading older textbooks, you'll see terms like NBFC-D for non-deposit and NBFC-NDSI for systemically important. Those acronyms are effectively dead. From October 2022 onwards, all references to NBFC-ND effectively mean the base layer, and NDSI means either middle or upper layer.
Exactly.
As an auditor, the very first thing you do after confirming a company is an NBFC using the AI 50 test is map them onto the BMUT scale. Are they base, middle, upper, or top? Because the layer they sit in dictates every single mathematical rule you will audit them against.
The layer defines the rules of the game.
Which is the perfect transition to the actual math.
Yeah.
Let's talk about the number game. Capital requirements and net owned funds, or NOF. You can't just wake up, form a company, and start lending money with the loose change in your pocket.
Right. You need serious scare in the game.
The regulations detail the requirement to have a minimum net owned fund just to legally exist as an NBFC. But the RBI is currently executing what they call a glide path. What does that actually mean on the ground?
The glide path is a brilliant piece of macroeconomic engineering by the RBI. Historically, the baseline NOF for many existing NBFCs was just 2 crore rupees.
Which doesn't sound like a lot of money when you're talking about lending to the public.
It's not. However, under the new scale-based regulations, the RBI looked at the modern, multi-trillion rupee economy and decided that 2 crore is simply not enough of a buffer to absorb losses. They're raising the mandatory minimum NOF requirement to 10 crore.
But wait, if they just announced tomorrow, hey everyone, you need 8 crore more by Friday, Wouldn't that just cause chaos?
It would cause an absolute bloodbath. If the RBI demanded that extra capital overnight, hundreds, maybe thousands of smaller regional NBFCs would instantly become non-compliant. They would face forced liquidation.
And who gets hurt?
Exactly.
Yeah.
The rural customers, the micro enterprises, the exact people those small NBFCs serve. So to prevent a market shock, the RBI established a phase-in period, a glide path.
Giving them time to adjust.
Yes. For entities like investment and credit companies, microfinance institutions, and factors, they don't need 10 crore today. They must hit stepping stones, 5 crore or 7 crore by March 31st, 2025, and then finally reach the full 10 crore by March 31st, 2027.
That makes a lot of sense. This gives serious, viable businesses the runway to retain their earnings or go out and raise fresh capital from investors while slowly and safely squeezing out the dormant, unserious, or undercapitalized players.
It's like gently turning up the heat to boil the water, rather than throwing them straight into the fire.
But we have to remember our BMUT layers here, because there are exceptions. Remember our base layer friends, the pure tech platforms. The P2P lenders and account aggregators get to stay at the old 2 crore NOF level because they don't hold the massive credit risk.
Exactly.
On the flip side, if you are an infrastructure finance company, your NOF requirement isn't 10 crore. It is a staggering 300 crore rupees, which makes sense because if you're financing a hydroelectric dam or a national highway, 10 crore wouldn't even cover the concrete.
It's proportional to the risk they're taking on.
Now, beyond just having that raw NOF number sitting in the bank, the auditor has to calculate the capital adequacy ratio, or CRR, and this is where the strict, unforgiving math comes in. The regulations state that the total capital ratio, which is your Tier 1 plus your Tier 2 capital, cannot be less than 15% of the aggregate risk-weighted assets. And within that 15%, the Tier 1 capital alone must be at least 10%.
Yes, except for some specific cases like MFIs and gold loan companies, but generally, yes.
Now, I know Tier 1 capital sounds like banking jargon. Can you break down what it actually means and, more importantly, how an auditor verifies it? Because there is a massive trap here involving cross-holding.
Absolutely, and this is where an auditor really earns their fee. Tier 1 capital is essentially the highest quality, most reliable form of capital a company possesses. It is the permanent core capital. For NBFCs, Tier 1 capital is defined as the owned funds, which means paid-up equity capital, free reserves, and share premium.
Okay, basically the hard money the company actually has.
Exactly. But then comes the crucial part. The auditor must deduct from that total any investments the NBFC has made in the shares of other NBFCs, and any investments in debentures, bonds, or loans given to subsidiaries or companies within the same corporate group.
Wait, why the mandatory deduction? If they made an investment, isn't that an asset?
It is an asset, but it cannot be counted as regulatory capital because of a financial illusion called cross-holding.
A financial illusion. Okay, explain that.
Let's walk through a scenario. Imagine a corporate promoter sets up NBFC A with 10 crore rupees of real hard cash equity. That is their Tier 1 capital.
Okay.
But then NBFC A takes that exact same 10 crore and uses it to buy the equity shares of a newly formed subsidiary, NBFC B.
I see where this is going.
If the RBI didn't force the auditor to deduct that investment, NBFC A would claim 10 crore in Tier 1 capital, and NBFC B would also claim that same 10 crore as their Tier 1 capital. The consolidated group would look like it has 20 crore of shock-absorbing capital.
But there's really only 10 crore.
Exactly. It creates the illusion of deep capitalization when, in reality, there is only one original pot of money. It is a shell game. By forcing the auditor to deduct investments in group companies, the RBI ensures that the Tier 1 capital representing that mandatory 10% minimum is real, unencumbered, hard cash or equity available to absorb actual losses, not just accounting fiction bouncing back and forth between related entities.
So if an auditor misses a cross-holding deduction, they are allowing a dangerously undercapitalized NBFC to operate.
You are, and that's a massive failure.
That is a phenomenal example. You cannot double count the same rupee to trick the regulator. Okay, we are making great time, and we are about to enter the most heavily tested, most scrutinized, and mathematically tricky part of any NBFC audit. We are moving into asset classification and provisioning.
This is the core of the audit.
I like to call this the life cycle of a bad loan. Because when an NBFC lends money, the entire business model relies on that money coming back with interest. But when a borrower stops paying, the auditor has to step in, classify exactly how toxic the loan has become, and then force the NBFC to take a hit to their profit and set aside hard cash provisions to cover the expected loss.
Yes.
To help you memorize the 4 stages of this life cycle, here is your next mnemonic: SSDL. 4 letters that dictate the health of the entire loan book. SSDL.
Let's hear it.
The first S stands for standard. The second S stands for substandard. The D stands for doubtful. And the L stands for loss. Standard, substandard, doubtful, loss. SSDL.
That's very straightforward.
So walk us through this timeline of trouble. How does a perfectly good loan devolve all the way down to a total loss?
The entire classification system is driven by time specifically, how long the borrower has been in default. If we connect this to the bigger picture, let's start at the top of the SSDL chain.
Standard.
Right. A standard asset is exactly what it sounds like. There is no default in the repayment of principal or interest. The account is regular, the borrower is paying on time every month, and the loan does not disclose any inherent problem.
Happy days.
Happy days. However, the moment a borrower misses payments and the loan officially becomes a non-performing asset, or NPA, it is immediately downgraded to a substandard asset. Now, the critical question for the auditor is, how long does it stay classified as substandard before it gets worse?
And this is where the SBR layers come back, right?
Yes, this is where the new scale-based regulations, your BMUT layers, directly impact the audit math. If you are auditing a base layer NBFC, the smaller non-deposit ones and asset remain substandard for a period of up to 18 months.
Okay, 18 months.
But if the NBFC is in the middle layer or upper layer, meaning they take deposits or are systemically important, the RBI is much stricter. For those higher layers, an asset remains substandard for only up to 12 months.
So the RBI forces the bigger players to recognize the pain faster.
Exactly, because their risk footprint is bigger. Once the loan exceeds that 18-month or 12-month window, it drops into the doubtful asset category. It has been bad for a long time, and the likelihood of ever seeing full recovery is highly questionable.
And then the final stage.
Finally, we reach the bottom of the barrel, the loss asset. This is an asset that has been definitively identified as an uncollectible loss by the NBFC itself, or by the internal auditor, the statutory auditor, or the RBI during an inspection, but it has not yet been physically written off the balance sheet. The money is gone.
Okay, so that is the SSDL timeline. But simply tagging the loan with a classification is only step 1. As the statutory auditor, you then have to run the provisioning matrix.
The math part.
Yes, you have to ensure the NBFC's CFO has actually set aside specific percentages of their profit to cover these bad loans. Let's drill these percentages, because whether you are in an exam or an audit committee meeting, you have to know these colds. Let's work backward from worst to best.
Okay, starting with loss.
Starting with loss assets, this one is straightforward, 100%. The entire asset must be fully provided for or completely written off. The money is gone. You have to force management to recognize the reality on their P&L.
There's no escaping that one.
Next, we move up to doubtful assets. This is where the math gets intensely tricky, because the auditor has to split the loan into 2 parts: the unsecured portion and the secured portion.
Right.
Let's say a borrower defaults on a 10 lakh rupee loan. For any unsecured portion of that doubtful asset, meaning the part of the loan not covered by any physical collateral, the provision is 100%.
Naturally, if you don't have collateral on a loan that has been bad for over a year, you're never getting that money back. Provide for it fully.
But what about the secured portion? What if that 10 lakh loan is backed by a commercial truck? Here, the provision scales up the longer the loan remains doubtful. If it has been doubtful for up to 1 year, the provision is 20% of the secured value.
Okay.
If it has been doubtful for 1 to 3 years, the provision bumps up to 30%. If it has been doubtful for more than 3 years, the provision is a massive 50%. Now I have to ask, why does the RBI force the NBFC to take a 50% provision hit if they legally hold the title to the truck? Shouldn't the collateral protect them?
In theory, yes. In reality, absolutely not. The RBI knows that physical collateral depreciates and legal recovery takes time.
Think about that commercial truck.
Imagine it. The borrower defaults. The loan becomes 1-2. Doubtful. That truck isn't sitting in a pristine garage. It is likely sitting in a dusty recovery yard, rusting in the monsoon rain. The tires are rotting, the engine is seizing up.
Or real estate.
Yes. Consider real estate collateral. It can easily get tied up in Indian civil litigation courts for a decade. The longer an asset is classified as doubtful, the more the underlying security actively erodes in market value, and the harder it becomes to liquidate it for cash.
Wow, so the escalating percentages, the 20, 30, 50, they force management to acknowledge that reality.
Exactly. They force the NBFC's management to acknowledge on their balance sheet that the simple passage of time is destroying the value of their safety net. You cannot carry a rusted 3-year-old seized tractor on your books at its original purchase price.
That makes perfect sense. Time destroys collateral. Moving up the SSDL chain to substandard assets, this one is easier for the auditor. A flat 10%. Regardless of whether the loan is secured by a fleet of trucks or completely unsecured, if it is in the substandard window, you ensure a flat 10% provision on the total outstanding amount.
Correct.
And finally, standard assets. Please do not forget these. This is a massive trap. You might look at a loan and think, the borrower is paying on time every month, the loan is perfectly healthy, zero provision required.
But that would be wrong.
Wrong. The RBI requires provision even on perfectly healthy loans. It is called a contingent provision against standard assets. The percentage varies from 0.25% to 2% depending on the exact nature of the loan, whether it's housing, SME, or commercial real estate. But wait, why tax a good loan? If the borrower is paying, why force the NBFC to set aside cash?
Because the RBI is planning for black swan events.
The unexpected.
Exactly. Macroeconomic shocks happen without warning. A global pandemic, a sudden change in export tariffs, a massive natural disaster. Perfectly good loans can turn severely bad overnight. The contingent provision on standard assets ensures that the NBFC builds a baseline buffer of capital during the good times, so they aren't instantly wiped out when the broader economy suddenly turns hostile.
So the key takeaway for the auditor is absolute. Every single loan on the book requires some level of provision.
Every single one.
Before we leave Section 5, we have to talk about income recognition. This is a massive red flag area where auditors catch companies trying to actively inflate their profits.
Oh, yes. The accrual versus cash basis battle.
Right. The standard accounting practice for almost every modern business is the accrual basis. You recognize income when it is earned, not when the cash actually hits your bank account. If you send an invoice, you book the revenue. But the RBI violently disrupts this practice for bad loans. The moment an asset is classified as an NPA, meaning it drops into substandard, doubtful, or loss, the RBI halts accrual accounting for that specific asset. The rule is absolute. Interest income, discount charges, or lease rentals on an NPA shall be recognized only when it is actually realized. You must switch entirely to the cash basis.
And here's the mechanism where auditors find the most friction with management.
Because it's not just about stopping future accruals.
No, it's about the past. Any income that the NBFC recognized on an accrual basis before the asset became non-performing but remains unrealized and unpaid must be reversed.
You have to actually go back and wipe it out.
Yes.
Yeah.
You have to erase that phantom profit off the P&L. If you are auditing an NBFC and you see they are continuing to accrue and report interest income on a commercial real estate loan that hasn't paid a dime in 6 months, that is a critical audit finding.
Management is just trying to present a falsely inflated profit margin to their shareholders by claiming income from a borrower who is effectively broke.
And the auditor must force the reversal.
You cannot claim you made money if the borrower's pockets are empty. All right, let's take a quick breath. We have covered the definitions, the BMUT layers, the NOF capital rules, and the SSDL provisioning math. Now, we are diving into the trenches. We are opening the auditor's playbook.
Let's get into the mechanics.
We've talked about the theory. Let's talk about the physical mechanics of the audit. What are you actually doing when you are sitting in the client's office reviewing their files?
Here's where it gets really interesting.
Let's start with internal controls. Every audit relies on checking internal controls, but for an NBFC, the regulatory guidelines highlight one specific operational system above all others.
The recovery system. An auditor must intensely review the effectiveness of the system of recovery prevalent at the NBFC. You need to ask management, is there a genuine, robust, documented system of periodical review of advances?
Why is the RBI so obsessed with this?
Because of the danger of sticky advances. Let's say a borrower misses a payment by 5 days. If an NBFC does not actively monitor its borrowers on a granular month-to-month basis, a minor cash flow issue for a small business borrower can silently snowball.
Like they take on other debt to cover the shortfall, their leverage spikes, and suddenly they are drowning.
Exactly. By the time the NBFC's management realizes there is a systemic problem, the loan is deeply submerged and entirely unrecoverable. The absence of a strict periodical review system leads directly to the non-detection of these sticky advances at their inception, which ultimately results in an alarmingly high spike in NPAs a year later.
So as an auditor, you aren't just checking if the CFO's spreadsheet math is right. You are evaluating if the loan officers are actually paying attention to the money they lent out. Are they visiting the borrowers? Are they checking stock statement?
You're checking the actual operational health.
Next on the playbook checklist, Public deposits. If you are auditing a middle-layer deposit-taking NBFC, the rules are incredibly tight because remember, there is no DICGC insurance.
That changes everything.
First, you have to physically test-check the interest calculations. The RBI enforces a strict ceiling on the maximum interest rate an NBFC can offer to attract public deposits. If you see the NBFC is desperately offering sky-high interest rates to suck in retail cash, they are violating RBI directions, and it is usually a sign of a severe liquidity crisis.
A huge red flag.
Second, you have to check renewals. Matured public deposits cannot be automatically renewed. You must pull the files and verify that no deposit was renewed without the express, written, voluntary consent of the depositor. No sneaky automatic rollovers to trap people's money.
Right, they have to proactively opt in.
Third, and this is massive for liquidity, every NBFC holding public deposits must invest a specified percentage of those deposits in approved liquid assets like government securities. This is their emergency fund. And the auditor has to verify that these liquid assets are lodged in safe custody with a designated scheduled commercial bank.
You literally have to verify the physical certificate.
Or digital confirmation, right?
Right, from the commercial bank, proving those safety net assets are locked away, untouched, and unencumbered. Continuing with the playbook, the auditor must conduct rigorous investment verification. You cannot just take management's word that they hold a portfolio of shares.
You can't just trust the spreadsheet.
No, you must physically verify the shares and securities. If the securities are dematerialized and held through a central depository like the NSDL or the CDSL, the auditor must obtain a direct, independent confirmation statement from the depository, bypassing management entirely.
And there are specific prohibitions you're hunting for, right?
Yes. For instance, you must verify that the NBFC has not advanced any loans against the security of its own shares.
Wait, why would an NBFC loan money to someone to buy its own stock?
It is a market manipulation tactic. It artificially props up their own share price while simultaneously hollowing out their actual capital base. It is a massive regulatory violation.
That's incredible.
Additionally, the auditor needs to look very closely at unquoted debentures. These are debt instruments issued by private companies that are not traded on any public stock exchange, so they have no transparent market value.
Okay.
The guidelines explicitly direct the auditor to check whether investments in these unquoted debentures have been correctly treated as term loans rather than classified as investments for the purposes of income recognition and asset classification.
I see the trick. If a loan goes bad, the CFO just reclassifies it as an investment in an unquoted debenture to hide it from the SSDL provisioning matrix.
Precisely. It prevents the NBFC from window dressing their balance sheet by hiding toxic loans in the investment portfolio.
Sneaky. It is truly amazing how many creative ways a company will try to massage a balance sheet. And speaking of sneaky behavior, the auditor's playbook also heavily emphasizes fraud detection.
It's an unfortunate reality.
You aren't just looking for general bad behavior. The RBI mandates that auditors look for specific classifications of fraud. Why are NBFCs so vulnerable to fraud compared to, say, a software company? And what exactly are we looking for?
Well, NBFCs deal entirely in liquid capital. Their inventory is cash. That makes them inherently vulnerable to internal and external fraud. The auditor must look for specific red flags.
Like what?
For example, misappropriation of funds. Are loan officers creating fake borrower profiles and routing the dispersed loan amounts into their own bank accounts?
That's bold.
It happens. Then there are fictitious encashments. This is where an employee might manipulate the system to show a deposit has been withdrawn by a customer when in reality the employee pocketed the cash.
Wow.
You also have to look for unauthorized credit facilities extended as a favor or for illegal gratification. Is the branch manager waiving collateral requirements and approving massive loans for their brother-in-law's failing business?
So you're looking for gross negligence and straight-up cheating or forgery of KYC documents to push through bad loans just to hit lending targets?
Exactly. And if an auditor spots any indicators of these specific frauds, it completely changes the trajectory of the audit. It triggers an entirely different level of mandatory reporting.
Which brings us to the climax of the audit and our final major topic, the auditor's burden, dual reporting duties.
This is where it gets heavy.
If you are auditing a normal manufacturing company, your primary duty is straightforward. You review the books, you issue your audit report to the shareholders under Section 143 of the Companies Act, you sign off, and you go home.
Right.
But auditing an NBFC is profoundly different. The burden is heavier.
Significantly heavier. The regulatory framework establishes an increased dual responsibility for the statutory auditor of an NBFC. You do not just report to the shareholders. You are legally responsible for making an additional separate report directly to the board of directors of the NBFC.
And what's in that report?
This report covers specific matters defined by RBI directions. You are obligated to formally present to the board exactly where they stand regarding their legal compliance, their AI 50 principal business metrics, their BMU key classification, and their capital adequacy ratios. You cannot let the board claim ignorance.
But it gets even heavier than reporting to the board. It is time to talk about the snitch rule. This is exception reporting directly to the RBI.
The snitch rule. I like that.
Under the Non-Banking Financial Companies Auditors Report, Reserve Bank Directions of 2016, if the auditor finds that the company is failing to comply with crucial regulations, they have a legal duty to bypass the CFO, bypass the CEO, bypass the board of directors, and snitch directly to the regional office of the Reserve Bank of India.
It is a highly uncomfortable but absolutely necessary position for an auditor.
What kind of violations trigger this exception report?
Well, if the company fails the AI 50 test, but is still operating and taking deposits, if they are missing their minimum net owned funds requirement on the glide path, if they are failing to maintain their capital adequacy ratio of 15%.
So the big structural stuff.
Yes, if any of these core structural pillars are compromised, the auditor must draft an exception report and submit it directly to the RBI.
Let's role play that for a second because the human element is intense. You are the auditor. You realize the capital adequacy has dropped 12%. You know you have to trigger the snitch rule. You can't just put it in a tiny footnote on page 40 of the annual report and hope management fixes it next quarter.
No, you can't hide it.
You have to walk into the CEO's office knowing they pay your audit fee and tell them you are actively ringing the alarm bell at the central bank. That takes serious professional courage.
It really does. But the consequences of failing to do so are catastrophic for the auditor's career and for the public. The RBI relies on the auditor to be their eyes and ears.
And this reporting burden extends to the main audit report as well, right? Under CARO 2020.
Yes, the company's auditor's report order, specifically Clause 3, part of bubble. This clause is laser-focused on exposing NBFC compliance issues to the public. Under Clause 3(5), the auditor is legally required to explicitly state in their public report certain things.
Like what?
Whether the company is required to be registered under Section 45IA of the RBI Act, and if so, whether that registration has been obtained. Whether the company has conducted any non-banking financial or housing finance activities without a valid certificate of registration from the RBI.
Okay, so clearly calling out if they are operating illegally.
Exactly. And whether the company is a core investment company and continues to actually fulfill the criteria to remain exempt. And finally, whether the broader corporate group has more than one CIC, which could indicate complex structuring to avoid oversight.
Let's use a hypothetical scenario to really cement how this plays out in practice. Let's call our target Satyam PVT Ltd.
Okay, Satyam PVT Ltd.
You are the auditor assigned to Satyam PVT Ltd. You walk in, pull their financials, and run your AI 50 test. Their total assets, minus all intangibles, sit at 6 a ton 8 crore. You look at their loan book and investments, their financial assets are 374 crore. You do the math. 374 divided by 6 and 8 is 61%. It's well over the 50% mark. Strike one.
Strike one.
Then you pull their P&L. Their gross income is 118 crore. Their interest and dividend income from those financial assets is 68 crore. 68 divided by 118 is 57%, over the 50% mark. Strike two. Satyam PVT Ltd. absolutely meets the AI 50 test. They are an NBFC.
Oh, numbers don't lie.
So you sit down with the management team and ask for their RBI certificate of registration. And the CEO smiles and says, oh, we don't have one. We actually applied for it 6 months ago. We're just waiting on the paperwork. But we have clients who need money, so we just start operating anyway. It's fine. Just sign off on the audit.
Yeah, that happens.
What do you do?
You absolutely do not sign off cleanly. Under CARO 2020 Clause 318B, You must explicitly state in your audit report that Sachin PVT Ltd is actively conducting non-banking financial activities without a valid certificate of registration from the Reserve Bank of India.
You just throw it out there for the world to see.
You must plant a massive, highly visible red flag right in the middle of your report. You cannot accept "we applied for it" as a valid excuse. Operating without the cart here is a severe violation of the RBI Act.
The auditor really is the ultimate gatekeeper.
They have to be. The RBI cannot physically place a government inspector inside all 9,000-plus NBFCs in the country every single day. They rely entirely, 100%, on the statutory auditor. The auditor must run the AI-50 test. The auditor must accurately map the company onto the BMUT scale. The auditor must verify the harsh SSDL provisioning math. And the auditor must report fearlessly through CARO and direct exception reporting if the entity is violating the law.
Because the whole system depends on it.
Exactly. The stability of the microfinance sector, the housing finance market, and the broader commercial credit market rests heavily on the diligence of the auditor following this exact playbook. If the auditors fail, the system fails.
Wow. Okay. We have covered an immense amount of ground today. We have gone from the basic definitions all the way to confronting the CEO. If you were preparing for your professional exam or you were walking into an audit committee meeting tomorrow, you now have the conceptual framework and the specific tools to completely dominate this topic.
You are definitely ready.
Before we go, let's do a rapid-fire recap of the memory tools I built to help you survive this material.
Let's run through them.
First, how do you mathematically define an NBFC AI-50? Financial assets greater than 50%, financial income greater than 50%.
Check.
Second, who gets a free pass from RBI registration? It's a SINCH, SEBI, insurance, needy, chit funds, housing finance, and remember the CICs.
Check.
Third, how do NBFCs fundamentally differ from banks? DDDP, no demand deposits, no drawings by check, no DICGC deposit insurance, no priority sector mandates.
Vital to remember.
Fourth, what is the new scale-based regulation layer cake? BMUT base, middle, upper, top.
Check.
And finally, what is the life cycle of a bad loan for provisioning? SSDL, standard, substandard, doubtful, loss. If you walk into your exam or your boardroom and confidently deploy AI-50, SINCH, DDDP, BMUT, and SSTL, you are going to look like an absolute genius. You have got the mechanics of this locked in.
As we wrap up this deep dive, I want to leave you with a final thought to mull over something that expands beyond the immediate regulations we covered today and looks to the future.
I love a good final thought. Let's hear it.
We discussed the scale-based regulations, and specifically, the top layer of the BMUT cake. We noted that the top layer is ideally meant to remain entirely empty, acting only as a putative quarantine zone for when a massive upper layer NBFC suddenly poses a systemic risk.
Right.
But I want you to consider the rapid explosive evolution of digital finance. We talked about base layer entities like account aggregators and interconnected digital PDP lending platforms.
Like FineApp.
Exactly. As these digital-first, algorithm-driven NBFCs gobble up massive market share at unprecedented speeds, they are intertwining themselves with millions of retail investors and traditional high-street banks simultaneously.
They're becoming huge, incredibly fast.
Exactly. So how long will it really be before the RBI is forced to populate that empty top layer? When a digital NBFC can process and disperse millions of microloans in seconds via a smartphone app, the speed of financial contagion changes entirely. A collapse wouldn't take months. It could happen in hours.
That's terrifying.
Is an empty top layer truly a sign of a well-regulated, healthy economy? Or is it simply the calm before a regulatory storm, waiting for the first massive digital systemic collapse to force the RBI's hand? It is a fascinating question about the future of financial regulation and something for you to explore as you move forward in your career as a financial professional.
What an incredible question to end on. The regulatory landscape is moving so fast, the rulemakers are just trying to keep pace with the technology.
They really are.
Well, we want to warmly thank you for joining us on this deep dive. We hope we've acted as excellent tutors today, demystifying the dense, high-stakes world of NBFC audits and giving you the memory tools to succeed.
It's a bit of a pleasure.
Until next time, keep learning, keep questioning, and good luck with your exams and your audits.